I'm really sorry for being late. Look at all the comments too. Uh, no internet, just went out. Poof. Finally back on. So my apologies. And let's say hello to everyone. I have my show notes were wiped out. Everything I had set up for the most part was wiped out. So this is probably gonna be a short show. Uh, Corey, hello. I'll be working. Good afternoon, Bob. I'll be working and can't join live. I'll watch later. Yes, I can. Yes, Corey. UNG. Jody. Nice and early today. Her alert fired off. Pete, welcome. Yep, we're going to be going over that in a moment. Sean, hello. Franklin. Yeah, the internet just. I went upstairs. I was working, got the show notes all ready to go, and then I came back down. Everything's gone. All right. Hi, Franklin. Let's let's get serious about higher rates ahead. The market is luring us right in the face. I love that. It's a very very good point, Larry. The 30-year bond is about to potentially break out and above a four handle. We're going to go over the weekly charts as we normally do. Always remember that we have one trading day left to go. So Thursday nights this is our pulse check, right? For whether or not we believe this week is going to close positive, negative, strong, weak, milk toast. And we need to keep in mind that we have one trading day left to go. On Saturday with members, we're going to go over the closing charts of the week, formulate a strategy. So if you're not currently a member, please sign up, 14-day free trial offer. And let's begin with an article that came out. It's on Zero Hedge. S&P entered the bull market and tech outperformed as yields declined due to spike in initial jobless claims. So, okay. I don't think today was a bearish day for yields whatsoever. If you take a look at the chart, all my charts messed up. Where's my 10-year? Here we go. The 10-year yield is positive on the week, and this looks as though we are getting to move up higher. So the article cites that you have technology rallying. Well, what's the one thing that could really adversely impact technology and derail any rally? Rising interest rates. You get a 10-year yield above a four handle to, let's say, 4.25, you're going to see technology begin to waver. And we do have some resistance above on the 10-year. But if we start breaking out and above these resistance levels, remember back here when we hit a 4.3 handle on the 10-year yield, stocks went poof. They couldn't take it. Now we've had a lot of job cuts at many of these companies, so maybe they can handle a 4.4, 4.5 on the 10-year yield, and we'll see how they hold up. But as it stands right now, yields are in a range where equities can continue higher. When I take a look at the S&P 500, we're using TrendSpider, link below, 35% discount code. When I look at this chart here, weekly chart of the S&P 500, we're stepping up higher. We're probably going to move higher from here. The weekly volume candlesticks are declining, not looking good in terms of volume. I do like volume. And in terms of the relative strength, the RSI, and this is the S&P relative to itself, RSI is looking very strong. So the path of least resistance for the S&P 500 appears to be to the upside. We have support immediately below and resistance immediately above. Do we break out? One trading day left to go. We'll find out tomorrow. So, why is the market rallying? What's going on that's causing equities to begin to broaden out? Is it a healthy picture of the economy? No. It's the exact opposite. It's a weakening picture of the economy that has equities wanting to move up higher. Why? The Federal Reserve is going to pivot. How do we know it's going to pivot? Simple. The Federal Reserve always does as expected. And as expected right now, the markets are expecting 71% probability no Fed rate hike this meeting coming up in June, 5 days from now. So, as long as this is what the market expects, the Federal Reserve is going to deliver. It always does. It's the forward looking guidance and the press conference out of the Federal Reserve that causes all the volatility that you see. So, uh, as it stands right now, unless, of course, some economic data comes out changing the picture entirely, it appears as though the Federal Reserve will do nothing. And think about this: you had a massively uh, stellar jobs report that came out last Friday, and pretty much on the very same day, nah, we're gonna skip this rate hike. Why would you do that if it was a legitimate number? Because think about it, you have the establishment survey, which is what the news reports. They reported in excess of 300,000 new jobs last month. For the month of May, over 300,000 new jobs. That's the establishment number. But the household number, that's a different survey, that reported a job loss of over 300,000 jobs. This has been going on. There's a huge divergence between household survey and establishment survey. It's been going on for over a year now. And if you go back in time, they generally trade or they trend in tandem. So they're manipulating the numbers. And what they do is they come back the next month and they beat by an outstanding number, but then they move down, they modify the prior read, which was a great number, and now they make it reality that, you know what, maybe it wasn't so great. So we're living in very, very corrupt times in this country. So I would really warn, if you are relying upon strong or reliable economic data out of the federal government, it's a fool's errand. Because while everything is supposed to be so all right and dandy with the economy, you still have the banks. Federal Reserve, Fed emergency bank bailout facility usage tops 100 billion for the first time as money market inflows soared again. So these banks are continuing to go to the Federal Reserve seeking a lifeline to stay afloat. Why? Why? I thought everything was so great. It's not great. And what's really not great is the fact that you have the commercial real estate market, which I had up here. My apologies. It's gone now because my internet went out. The commercial real estate market is in a massive bubble, the likes of which we haven't seen since 2008. All right, I'm going to give up here. You take my word for it. You have hotels over in San Francisco or Hilton. Hilton has franchises, right? So it's not Hilton Incorporated. They manage the property. So you have these real estate owners that have loans that are interest only. They don't pay down principal on these mortgages, and it's a great deal for the owners of the properties because all they're doing is paying the interest. You get a rise in property values, and they're living the dream. And why do banks make these types of loans that have worked all these years? Because commercial real estate prices generally are just gold. They just generally go up. The problem is that when they set these loans up in 2017, 2018, 2019, when you saw the uh, the beginning of the hybrid model, meaning work from home, was just a conversation piece. But then COVID hit, and people didn't want to go back to work in these office spaces. So now you have these loans that were made when these buildings were near 100% occupancy. Now they're at 50% occupancy. They're not worth what they were. Now these owners need to go back to the banks and say, I need to roll over that loan I took out in 2017, 2018, 2019 at par, at what I got the loan for the last time. The problem is the loans aren't worth that much. So what do these property owners do? Well, the way they structure the loans is that they create an LLC around each property. So you may have a fund that goes to a bank and says, listen, I need to refinance this property or take a loan out on this property. They're not doing it vis-a-vis the fund. They're setting up an LLC within the fund, going out, taking a loan on that property, and it firewalls off that bad loan from the rest of their properties. So what they're doing now, these landholders or property owners, they're just going to go to the banks and say, listen, if you're not going to roll over my mortgage, then here are the keys. You own it now. And they walk away. And nobody really wants to talk about this for some reason, but it's beginning to hit the headlines now. And at some point in time, the Federal Reserve or the government is going to need to come in, and they're going to have to bail out the commercial real estate market. So let's be careful with the market that we're seeing right now enter a new bull market. Can't believe I lost all these. Okay. I want to talk about, I titled this about valuations. And while today we may have entered a new bull market in the stock market, the S&P 500, we also have the highest read on the Shiller PE ratio since, I don't know, 2021, around 2021. And we're back above a 30 handle on the Shiller PE ratio. So this market is far more expensive than it was just prior to this most recent earnings report. So you have to be a believer that you're going to get multiple expansion going into the next quarter. I don't know why anybody would believe that, but you need to be, if you're investing long in this market and you believe that this time next year equity prices are going to be higher, you need to believe that the economy is growing and you're going to get multiple expansion. And you're buying stocks on the hope that the forward multiple on the S&P 500 is discounted. It's cheap. I prefer to go with the rear view mirror of what these companies are reporting and say, you know what? We have a 30 handle on this equity market, and it's susceptible to a major sell-off. I'm not saying it's going to crash, but keep in mind that once the Federal Reserve pivots, which the markets are expecting, usually when you get that first rate cut, you get a knee-jerk reaction to the upside on equities, and all of a sudden everything rolls over because everybody gets worried about what's wrong with the economy. That's when the conversation happens. So what I do want to take a look at is the yield curve and get a feel for how the yield curve is pricing out this week, because we know if the yield curve begins to steepen, then we could see a reaction in equities to the downside. And so far on the week, we're not seeing much of a reaction. We are up on the week, but you know what? This time last Thursday, we were up. We hockey sticked up, exact same as this. But by Friday end of business, we were down. So one trading day left to go. Right now, the market is shrugging off the beginning of a steepening yield curve. Let's see how we close out the week. If we close out the week flat or down on the yield curve, equities can continue higher. So all we're doing here is we're not pointing out that equities are, we're not saying that equities can't move up higher. They can. I fully expect that the S&P 500, IWM, which I pointed out last week on best stock charts, they were going to move up higher this week. And they sure enough did. In fact, the small caps on the week, it's on YouTube, I mentioned this, that the small caps would probably break out and outperform. Killing me. And they have. The small caps are up over 2.75%. And in all probability, they are going up higher. We're right at a resistance level at current on the small caps. Now, names that I like, Stokes looking very, very nice. Names that I like in this space and that are tech are names like AI. Now, I did a trade on them yesterday. I didn't stick with it. I was worried about the close in the market and how toppy AI had become. So what we're probably going to do is I'm probably going to sell premium in here on AI, maybe going out to next week. And if the shares are put to us, they're put to us. If they're not, they're not. We'll make money on the cash flow. So AI looking good here. It's taking a pause. That's okay. I think that ultimately this is going to get resolved to the upside. Let's go back. Now, while we were sleeping last night, Europe enters recession after data revisions paint a gloomier economic picture. So Europe has now entered a recession. Ireland, Netherlands. So yeah, they're in recession now. And we can expect at some point in time, we're going to get the same here. Why? Initial jobless claims have surged to the highest since October 2021. We've been seeing this for several weeks now, where the Thursday report, the weekly report on initial jobless claims, they're moving up higher each week. Look at the trend here. Look at the trend since September, and it's been nothing but up. Now, think about this. And then think about the Friday jobs numbers from last week, where we beat by over 300,000 jobs. Give me a break. Initial jobs claims are spiking up higher. That's a bogus number that we're getting. At some point in time, these lies that the government are telling us are going to hit the fan. So we're at 631. I lost a lot of my show notes. What I do want to do is I want to take a moment. I want to address Larry's comments earlier, and that we really need to be worried here a bit about the 30-year bond, because the 30-year bond or the 30-year yield is not something that the Federal Reserve can control. They could try to, but ultimately, I'm sure I have this saved. Here we go. So what we're looking at here is a chart that is somewhat dire, in that we have broken out above resistance. We did so several months ago. Now, what we've done is paused. And it appears as though we're getting ready for a move up higher. Now, why might this move up higher? The reason is that, remember that the Rhino Republicans with the Democrats passed a massive $4 trillion worth of spending. The U.S. consumer was so robbed on that deal. We have no representation. There's a uniparty in Washington. We have no representation in power. And they need to go to the market now, and they need to sell $4 trillion worth of treasuries. Now, you take a look at the U.S. balance sheet, which is at around $31 trillion in debt. And now you're going to come to market with $4 trillion in additional treasury issuances. You think that the market is going to demand higher yields or lower yields? They're going to demand higher yields. So expect that the 30-year yield is, in all probability, going to get spiked up higher. What does that do for the overall market? It increases borrowing costs. Remember, mortgages based upon the 30-year bond. You have borrowing costs for utilities. They borrow long. What happens? Their borrowing costs go up higher. What happens to their earnings per share? They go down. What happens to every company that goes to market and they want to issue bonds? Well, they're going to have to issue bonds and pay a higher yield because their bonds that they issue are perceived to be more risk than treasuries. So if treasury yields go up higher, so goes the borrowing cost for every single other company out there. What happens to their earnings per share once they have to pay out higher interest on their bonds? Earnings go down. The ability to reinvest into their businesses goes down. There's a massive ripple effect in the economy. So for all intents and purposes, what the federal government, as represented by the Uniparty, has done, they have gone into the private sector and stolen $4 trillion of productive money, meaning money that is out there in the private sector being invested, being used to buy goods and services, and they have taken it out and they have put it into unprofitable. It's just going to go to waste. You're going to send a lot of it over to Ukraine. It's going to go out to spending that is just, it's just waste. It's just the government trough. They produce nothing. And what that does is it slows down the economy. GDP is now going to slow down because of all the government spending. And what happens at the government level? They're going to need to go back to the trough again. Why? It's because the borrowing costs of the federal government at current on all the debt we have now, not what we're going to have tomorrow, but what we have now, is equal to the military budget of the United States, roughly $800 billion and rising. So going back to the valuation of the market, beware, folks. We have everything wrong. We have the federal government working against the markets. Everything they do possibly to hurt the markets, they are doing. And we have a market that is sporting a 30 handle. So if you want to speculate long, go for it. I'll speculate long too. But we have shorts on. We are prepared for the downside. So be careful out there. We're going to do some chart requests in a moment. So let's get, you tried to short Carvana today and got an error message. I'm sure. Yeah, it's going to be very, very difficult to short Carvana. As a matter of fact, let's do some chart requests. I'm already running out of time. Let me take a list down. We're going to go over Carvana, UNG, Tesla for Franklin, CCI for Pete, CVNA for Jody. Is it a short? Tim, ORGN. Hey, Tim. All right. Did I miss anybody? If I missed anybody, let me know, and we will get your charts seen. UNG. All right. So the monthly chart of UNG, it's up, but it's not great. RSI flatlining out here. Weekly view. It's trying to break out. RSI stair stepping up higher. Daily view. We broke out of this downtrend channel. Folks, I did not draw these lines. This is the algorithm. Click of a button. So we broke out. It appears as though they're trying to take UNG up higher. How are our stochastics looking? They're looking good. Let's take RSI off, clean this up a little bit. UNG is actually looking pretty good as a speculative bet. Once I would get a lot more bullish were we to close above a 7 handle on UNG. There's a lot of resistance above there. Next chart up, Tesla. For Mr. Franklin, Tesla had a really good day today. On the week, beautiful week, good volume. We're at the highs of the week. Daily view. Just keep in mind that we're gonna have resistance at around 238 per share. What a rally here. So my contrarian mind is thinking, hey, do I short this up and into resistance? I think the answer is yeah. Franklin, is that what you were thinking? You devil you. I know you. Now, if they gap it up above that level, we're not going to short it unless, of course, it fails. So we'll keep that active for 10 days. But Tesla looking to me to be it's going to go up higher, but I think you're going to be able to scalp a short on Tesla. Franklin, thanks. Yeah, I agree. We still have some institutional money going into Tesla. Look at the volume bars, pretty good. But I think that we're going to get a reaction off of these multiple resistance levels above to the downside on Tesla. Let's see how we close out the day, intraday. Yeah, there's a lot of resistance above. But it could still move up higher. Where do we close? So we have about $5 of upside here. A little bit less. Dane, CrowdStrike, you got it. All right, so Tesla, we're looking to short it on a spike up higher, and I'm pretty confident that's where it's going to go. CCI, Crown Castle. Interesting chart. This is a monthly view. All right, so on the month, when I see these stocks that have been in a bear market, when we're determining whether or not we're going to get a rally or whether the bear market is close to being done, the first thing the stock needs to do is what? It needs to stop going down. So that's why I go to the monthly chart to get a feel for, okay, what are we doing here? And on the month so far, we have not taken out a new lower low. It's early in the month, a lot can happen. But usually, if you're going to get a lower low on the month, it's going to happen at the front end of the month. There was no continuation breakdown here. If there is a continuation breakdown, we're coming down here to 103.38, 104, around there. Weekly view. This is going to be potentially one trading day left to go, potentially the second consecutive up week. Last week was very, very good volume. And at current, it appears as though we have a breakout. We broke out last week. This week, a retest of the breakout point and a continuation move up higher. Attractive. Stochastics, your momentum indicator, hooking up. Got to have that, like that. Daily view. The chart's looking good here on multiple time frames. It's still very speculative, but the path of least resistance at current appears to be the upside. You've had some good consolidation at around that $105 per share level, and it appears as though we are now beginning to break out. You have a congestion area of a lot of moving averages that are now beginning to hook up, and that's what you want to see. Slower dated moving averages moving up above the higher dated moving averages. Or I should say duration, not dated, higher duration. So CCI looking good here. Let's quickly check an intraday chart. See how we're going to open up tomorrow. We'll go with 30-minute view. 30-minute chart. They broke it out this afternoon. It's consolidating sideways. It looks as though they're going to try to break this back out. They try to break it down at the end of business today, but you had buyers in there that rescued it. So CCI looking good as a long trade. Carvana. Now, Carvana is a company that you have to worry about ongoing concern issues with. So on the month so far, very solid month. Here's a stock that was trading at a high of what? High of 376.83. And we closed today out at $24.23. Weekly view. We're very extended relative to the third standard deviation Bollinger Band. If you're looking to buy this stock, I would wait until you got a retracement, which is going to happen. If you have the patience, you can get the stock cheaper at around $18.50 per share. Now, being the options monster that I am, I want to check out premium here on Carvana. And let's play a game. All right, so CVNA. IV percentile, 31% attractive. Now, what did I say? 1850 was the price target. Rather than buying these shares right here, right now, I would rather, if I wanted to own the shares, I would rather sell an 1850 put. You'll get paid about, as of the close yesterday, You'll get paid about 65 cents per contract. So minimum contract 100 shares. So if you sell one contract, you'll get 65 bucks put in your pocket. Now, if it doesn't hit 1850 or close down below it, well, you made 65 bucks. Uh, if it gets put to you down below 1850, well, then you got a discount. So that's what I would do here. I would look to sell premium on Carvana rather than going out and buying the common stock, because this is going to retrace. As sure as God made green little apples, it's going to retrace. Look at this daily chart. This is ridiculous. So what's the support level here? It's a little bit above where I put my support level. This is the algorithm drawn for us. Uh, I like mine better at 1850. Good volume today. You know, this is going to be in play now. You're going to have Wall Street bets. They're going to go in there, spiking it up higher, playing games. Do not chase this stock. And it could probably hit 50, 60 bucks a share. But I would not go home long with this stock overnight. I'm sorry. I would not do it. You are welcome, Jody. Yeah, I'm with you. Day trading, fine, but I agree with you 1,000%, Paul. I would not be able to rest at night going home long of Carvana or short for that matter. It can only be a day trade. What else do we have? ORGN. This is another one that appears to be coming back to life. Not a lot of data to analyze the monthly chart, but it's an inside month. No new lower low. So we've stopped going down. It's met that criteria. We broke out this week. Weekly stochastics, or that's your momentum indicator, moving up higher. Good stuff. Daily view, a down session. That's okay. Took a pause. It took a pause. Note right on top of this volume shelf. So a logical support level. I think it's looking good. I think it's probably going to move up higher. Let's see how we closed out the day. 30-minute view. Interesting. So on a 30-minute view, we are in a very, very tight consolidation range. We broke out above it today, and it appears as though they're going to try to spike this up higher tomorrow. So the reason why this couldn't close positive is this overhead supply that you have above at around $5 a share, $4.82 to be specific. But if you get a close above this, then that makes it an interesting long. I would be interested in how many days to cover on short interest. And we're good to go. Our alert is set. Now we forget. All right, CRWD. CrowdStrike. An inside month. They reported earnings. I guess they gapped up on earnings. It's looking good. It's looking very good. A little bit of resistance above at the let's call it 160. Oh, this is going to move. So we broke out on CrowdStrike moved up higher, now consolidating. Now what we're looking for is a breakout. I think that CrowdStrike can be bought. Let's check out IV rank here. I don't think it's going to be that high. I doubt it, especially with VIX so low. Yeah, there's no volatility in this. So there's no options trade that can be had for cash flow strategy. If you want the shares, you want to sell the 150, 140 puts. What would the 140 puts bring you in? Let's go out to next week. Probably not much. Not much. That's a lot of capital put to work for, maybe 47 cents per contract. But I think that the common stock is ultimately going to break out here. Daily view. Yeah, this is flagging out. This is going to move up higher. The only thing I don't like is daily momentum is waning a little bit here and moving lower. But otherwise, the chart looks good. The intraday charts, the 30-minute, the 15-minute charts are looking really good. We'll begin with the 30-minute. Here's your W formation. Here's your left side. Here's your pivot point, right side. And then once you broke above this pivot point at 150.59, it was off to the races. Now we pulled back, and what do we do? Higher, low. Then we broke out. This is going up. This is going up. In your early stages of a breakout here, I like CrowdStrike. It's going up higher. So bullish on CrowdStrike. Let's see if I have anything in the members area. And if anybody else has anything else, we have a couple of minutes. Did I miss anybody? I don't think I did. Let me go to the members area and make sure I'm not forgetting anybody. Apple. Monthly view first, as always. Apple hit new all-time highs this month. Weekly view. As soon as we hit those highs, note how as soon as we hit this rising upper band of resistance, it sold off. This is the power of the algorithm, folks. The computer does it for you, AI. So right now, Apple is struggling here. I think it'll probably get resolved to the upside. As a matter of fact, this is not a weekly chart, it's a daily chart. Let's go back. I skipped over a chart. It's got to hold 180. If it fails to hold 180, we're going to retrace back down to 173 per share. Daily view. They tried to take it up today on very light volume. Let's see how they might open it tomorrow. Good close on the day. You want to see volume into the close, and we got that volume, but you saw a little bit of a fade off the highs. Let's drill down deeper. Yeah, and you see in the final 15 minutes of trade, some sellers moved in here to take it down off of the highs of the session on volume. So no clear sign of where Apple's going to open up tomorrow morning. Do we see continuation pressure in the morning on Apple? Maybe, maybe not. It could be day traders out there just exiting their positions. So Apple, a little bit iffy on right now. SLV, we'll leave it off with SLV for Paul. SLV, looking good. We are now positive on the month for silver. I'm loving the 2150 mark as support. At current on the week, we have a breakout on silver. And this all makes sense. We spoke about this on Sunday night. I titled that commentary on Sunday night, "Is it time to buy gold and silver?" or something like that. And the reason why I discussed it was because all the spending that was passed by the Uniparty, and who's going to finance it? The Federal Reserve, right? So that means more debt, weaker U.S. dollar. You saw the dollar today drop like a rock. What happened to silver and gold? Ripped up higher. So silver's looking good here to me as a long. Daily view, looking good. On volume, it closed up today. I'll probably be in there tomorrow myself buying some silver back. We sold it several weeks ago. We hit resistance, consolidated sideways. I think this gets resolved to the upside. Final 30 minutes of trade, we closed at the highs of this 30-minute bar. Look at the volume. This is when institutions put money to work, that final hour of trade. And man, that final half-hour trade today, they were in there buying hand over fist. How does this get resolved? In all probability, it gets resolved to the upside. So silver looking very, very good. Dane, I did not cover Meta. We'll leave it off with Meta. Meta, very extended here. I would be looking to short Meta. Why? That new product that Apple just came out with, competition for the metaverse. Here is the weekly chart. We have resistance as noted by this volume shelf immediately above at, let's call it 279 per share. So on the week, Meta is underperforming technology, and it broke support yesterday. And today, what it did is did a retest of the breakdown point. I think Meta goes down. I think this is going to fail, and it goes down. So I'm bearish on Meta. Let's check out the final 30 minutes of trade. They sold it off here, rallied it. They're trying to put in a higher low and break it out. If they break it out, then I'm not going to be bearish. But if they break it down, I think it's a potential short. So we'll be watching it. I would definitely be interested in selling premium here, but I don't know what you're going to get. Probably not much. Selling a strangle, but the VIX is so low. Yeah, there's no volatility in here. It's not even worth it. Let's go out to what, 45 days, 43 days. We're at 264. Not horrible. Not horrible. You want to sell a 225 put? Bringing around just shy of $1.15. Simultaneously sell a out of the money, equivalent out of the money call option, open up a strangle. That's probably the safest way to play this right now as a cash flow strategy. But I just don't like the low implied volatility, because if volatility kicks back in, then that trade becomes difficult to manage because you have an expansion of implied volatility and you're not getting the benefit of time decay. So I'm not loving the trade. I would rather probably just see a breakdown here and short it. I'm not bullish on the trade. I'd rather just short. Folks, with that, I'm going to say good night. Sorry for the technical difficulties. Thanks for being here. Like, subscribe, and I will talk to you folks on members. I'll talk to you tomorrow, but everyone else, I'll talk to you on Sunday Night Futures Live. There's a link below, my top 5 favorite candlestick patterns, 5-part video tutorial. Take advantage of it. If you enter your email address there, you'll get alerted about a half hour prior to us going live on every live stream. And until then, have an awesome night and a profitable trading day tomorrow. Be well.